Hi, everybody. Dr. L here with another installment. In this section, we are going to discuss how to apply our discounted cash flow analysis, our DCF framework, to the task of pricing a share of equity. So the agenda for this video, we're going to exploit the uniform annuity pricing framework to price a non-fixed income security. And this might sound difficult, but we're going to make a few assumptions and we're going to use a couple algebraic tricks to be able to appropriately apply this. So to do this, we're going to do the following. We're first going to consider what the structure of the cash flow stream is for somebody that is an equity holder of a share of stock. We're going to treat the flow of dividend payments as a deterministic cash flow, even though it isn't. And the way we're going to get around that is by making a constant geometric growth assumption that will allow us to provide at least a little bit of structure to the cash flow stream, given that dividends are not uniformly paid out. They change over time with the changing profitability climate that the company faces. And then we're going to go ahead and apply what is known as the growth annuity framework to this problem of dealing with the dividend payment stream that an equity shareholder is entitled to. And we will then conclude by applying the classical theory of asset pricing to express the price of a share of equity as a function of things like the discount rate, the growth rate of dividends, and the dividends themselves. So let's start by thinking about this question. What do you get when you own a share of company stock? And recall, we've discussed this, but if you're an equity holder of a firm, that means you have a right to the future profit stream of that firm. And in that regard, as a beneficiary of being a stock owner, you really get two benefits. The first is in terms of cash flows, you receive dividend payments. Those are potentially zero, but they're definitely not negative. And then you also receive some cash inflow at the time you decide to sell the stock, equal to P sub T if you sell the stock in period T. So if you were an individual that purchased some stock and owns it, and we wanted to look at the cash flow stream of what you would get by holding the stock and then selling it T periods later, that cash flow stream would look like the following, right? You collect your dividends, and then in the very last period, you're going to collect your dividend in period T as well as the selling price of the stock in period T. Now you'll notice this form here looks quite a lot like the cash flow stream that we got from a bond, right? Instead of dividends, we received coupon payments. And instead of the price of the stock at the very end, we got the face value of the bond back at the very end. So these look very similar, but the big difference is with the bond, we knew at time zero what the associated cash flow stream was, but we do not know at time zero what the dividend stream is going to be in the future or what the future potential selling price of a share of equity is going to be either. So all we're going to have to do here is think about discounting that cash flow stream, and then we can compute the price of the stock at time zero. Okay, but again, big logistic problem here is we don't know the future. We're not psychic. So we don't know two things. We don't know the future value of the dividend stream or the future value of the selling price of the stock, making the deterministic discounted cash flow framework fairly unrealistic to model a stock, but we're going to do it anyway by employing a fairly rigid but somewhat simplifying assumption. Before we impose that rigidity in here to provide a little bit of structure on the dividend payout stream, we're going to take a closer look at the payout streams, and we're going to follow the dividend stream as we watch the stock being sold to another person. We're going to look at what they collect, and then they sell it to somebody else. We'll look at what they collect, so on and so forth. So if you're the person who buys the stock in period zero and sells it in period T, then the entire net cash flow stream, if you're thinking about the stock as an investment, looks like this. Right? We get negative P0, we pay at time zero. We collect our dividends, then we sell the stock after collecting the dividend in period T. We get PT as the price back. However, that is not the end of the story for the stock. Now, that's the end of the story for this particular person who sells it. But if the person sells it in period T, somebody else must have bought it in period T. So we're going to now consider the perspective of the person who bought the stock in period T and then sells it J periods later. Okay, so if that happens, right? The same period that the person who bought it in period 0 sold the stock in period T, that has to be when this person buys it. So we can kind of think over here as this being the same time period, the period where the first person sells it, and then the period where the person who buys it faces the cash outflow. Hey, and then what happens? Well, the next person who owns the stock, they collect a bunch of dividends, and then they sell it, which means they collect the gross sales price of the stock. And now we can think about the third owner of the same stock who bought the stock in period T plus J and sells it K periods later. He also faces a very similar cash flow stream from the stock investment. Okay, so again, note when the person who bought it in period 0 sells it, the price they get is the same price that the person who bought it in period T pays. Similarly, when the person who bought it in period T sells it in period T plus J, the selling price for them in T plus J is the same as the purchase price of the third individual who was buying it in T plus J. Okay, so what we want to do here is we're going to recognize that there's a recursive nature of the pricing formula, that the price in period T reflects, has embedded in all these future values of future dividends and future prices. And we're going to recursively iterate on this idea by exploiting the classical theory. So again, we had these three different folks that face these three cash flow streams from buying and then selling the stock. And if the classical theory holds, it has to be the case that that price in period 0, it has to reflect the discounted value of the future payments that are received. So it has to reflect the present value of the dividends as well as the present value of that quote unquote face value payment of PT, the gross price of the stock when we sell it. Similarly, we can make the same argument for the price in period T from the second individual's perspective, right? The price in period T has to reflect all of the future dividends and the future price that that individual receives. And similarly for the individual who is buying the stock in period T plus J. Okay, so what we're going to do next is we're going to recognize, hey, we can substitute this expression for the price in period T into here from the perspective of the individual at buying the stock at period 0. Similarly, we can substitute the expression for the price in period T plus J here into the valuation expression for the individual that is purchasing at period T. When we do this, we're going to see that the present value of the future cash flows when we're thinking about the price in period 0 actually depends on all of the future dividends, not just the ones that you stand to collect from owning the stock, but even the future dividends that somebody else can collect after you sell the stock. And that should make sense. If there's a benefit to somebody else from owning that asset in the future, that benefit is going to be built in to you purchasing that asset today. So again, we're going to start with this perspective of the individual who purchased in period 0. Okay? And we're going to recognize that the price in period T reflected the present value of all the future dividends between period T and T plus J when that stock was sold. Okay. That means we can simplify now. So note, right now the present value of the dividend stream includes the dividends out to period T plus J. And we could keep iterating, right? What is the price in period T plus J? Well, that must reflect the present value of all those future dividends. So we could keep making the same argument recursively over and over as if that number J in the very bottom line was going towards infinity. Okay, and the point here is that if you're thinking about the cash flow stream yielded by the stock itself, okay, the stock is kind of like land. It never, the benefits it provides never end. It yields a perpetual cash flow stream. So that the price of the stock in period 0 is actually the present value of all of the dividends. And it doesn't matter if they're dividends you collect or dividends you don't collect. If you sell the stock, you'll get that future price, but that future price has built in the present values of all the dividends afterwards. Okay, so we're seeing here now that the stock actually is not a finite cash flow stream. It is a perpetual cash flow stream. Okay, and at the same time, we've solved one of our problems. Okay, we do not know the future price of the stock, but we've eliminated that from our analysis. Okay, all we have to deal with is the future dividends. Right? The price at any time reflected the discounted value of those future dividends, but we haven't eliminated the second problem, which is we do not know what the future dividends are. And to deal with this problem, we're going to go ahead and assume this problem away in a way that lets us reasonably apply the deterministic cash flow framework, and essentially bringing us back into a situation where we can utilize the uniform annuity framework. So in terms of applying the cash flow stream to equity valuation here, we've concluded the following: that if you want to value the stock's cash flow stream, you need to do that by considering this infinite non-uniform stream of dividends, right? The dividends, they change every period potentially. It's possible some of them are the same, but it is not like a fixed income security where they have to be at the time of purchase. So it would be really nice to use our uniform perpetuity framework to price the stock, but we're still in this situation where the dividends are not uniform. So in order to change the environment a little bit in a way that allows us to exploit that uniform annuity framework, we're going to assume that although different, the dividends are somewhat structurally related to each other. There's some mathematical structure that relates D1 to D2 and D2 to D3 and D1 to D3 through D2 and so on and so forth. And we're going to do that by assuming that the dividends grow at a constant geometric growth rate of G. If G is positive, the dividends are getting geometrically larger over time. If G is negative, the dividend stream is getting geometrically smaller over time. If G is 0, then we would be back in a uniform perpetuity framework, and we know what that should look like. Okay, so within this geometric growth framework, okay, we're basically asserting here that the dividend in period T is going to be tied to the dividend value in the previous period by this growth rate of G. So if we take dividend T, in T minus 1 and we multiply it by 1 plus G, that should give us the larger dividend next period, assuming the growth rate is positive. We'll see in a moment that this small adjustment will allow us to exploit the uniform perpetuity pricing framework to price the equity despite not knowing the future dividend values, right? How do we get around not knowing them? Well, we assume that they grow at some constant rate, which essentially allows us to project those values from the starting point. Okay, so we want to price this cash flow stream. And again, the dividends are assumed to be related structurally through this equation, right, using the growth rate G. And we're going to now go ahead and apply the classical theory to compute the present value of the dividend stream. And this is going to sound very repetitive, right? D1 divided by 1 plus R plus D2 divided by 1 plus R squared, so on and so forth. And take note that this is actually a perpetual stream here, right? Those dot, dot, dots at the end mean this term keeps going towards infinity. So do not forget that, that's important. Okay, so here we're going to start where we had just left off. And what we're going to do next is recognize that the geometric growth structure allows us again to take advantage of the recursive nature of how dividends may be related, right? Dividend 2 is equal to dividend 1 times 1 plus the growth rate. And dividend 3 is equal to dividend 2 times 1 plus the growth rate, which is equal to dividend 1 times 1 plus the growth rate squared, and so on and so forth. Meaning that it's possible for us to take all the dividends in the stream and express them recursively in terms of the dividend in period 1. Okay, so that is what we're going to show in this line below here. And we've rewritten the entire pricing formula as a function only of the dividend in period 1. Still catch 22, we don't know what that is in period 0. So we've partially fixed the problem. We didn't know the future dividends 2 through T through infinity. Okay, so we've eliminated that part of the problem, but still we don't know what D1 is. So we have to think about that a little bit. Now, we are in what is known as the growth annuity framework, right? The cash flow structure is growing geometrically over time. So this is not a uniform annuity framework, but we're going to use a convenient trick in a minute to bring us back into what looks like a uniform annuity situation. So again, we've written the pricing function as a function only of the dividends in period 1. And you'll notice there's a slight mathematical inconvenience if you take a look at the form of this equation here. And there's a slight inconvenience, and I'm going to argue the inconvenience is if you look at the exponents on the 1 plus g and 1 plus r terms, you'll notice those exponents in the numerator and the denominator do not match each other. Right? And the numerator has an exponent 1 smaller than the denominator. So what we're going to do is a little trick to get around that problem, and then we'll be able to move into the uniform annuity framework in a moment. So to get around this exponent mismatch problem here, what we're going to do is we're going to rewrite D1 in terms of D0. Now you might be saying, well, that's crazy because we don't have D0. It's not in the cash flow stream, right? And you said already, Steve, that when we buy the stock at period 0, they don't immediately turn around and pay us a dividend. So why would we do this? Okay, there is no dividend there in period 0. We're going to do this to use D0 as a temporary placeholder. We're going to think about that as really a virtual value. It's not really part of the cash flow stream. But once we do this, you'll notice we will fix our exponent mismatch problem. Okay, so here is now the substitution. And as I've suggested, if you look carefully at the exponents on 1 plus g and 1 plus r, they now match up. Okay, so from here, we're going to do the following. Okay, I'm going to go ahead and we can look and see that the structure of the pricing formula here now looks more like a uniform annuity, right? We can factor out that D0 from every single term. And then we would have some sort of geometric series left involving the growth factor and the interest factor, the ratio of those two things, squared, cubed, and summed up, so on and so forth. So what we're going to do here is a little trick. We're going to redefine our discount factor, but we're going to define it in a way that's adjusted for the growth rate. So now instead of delta just being 1 over 1 plus r, we're going to define delta as 1 plus g over 1 plus r. Okay, note that if g is 0, we're back in the original case of 0 growth, right? We would have a uniform cash flow stream. However, if g is not 0, we are able to now think in a much broader sense here with respect to the growth adjusted discount factor. For now, we're going to assume that g is smaller than r so that the discount factor has that nice property. It's between 0 and 1, so that when we square it, cube it, we raise it to higher powers, it gets smaller. And again, we remember we had some implications in terms of how patient people were in delaying future cash flow streams related to that discount factor as a measure of patience. So once we do this, okay, we start here where we've written everything as a function of D0, our virtual value. We're now going to carefully substitute the discount factor, but the growth adjusted discount factor, into the pricing function, and we find ourselves in a very, very familiar situation. Right? This looks like a perpetual stream of D0s, and we know how to price that already. If we have a uniform stream, a uniform perpetuity stream, we know how to price that. Okay, so we've transformed the problem into a uniform perpetuity problem, where it's as if we're valuing a stream of D0 being paid every period forever, but using this growth adjusted discount factor. Okay, so starting here, okay, we're going to do just what we did last time when we got to this point using the uniform annuity pricing framework, is we factored out the D0 delta from every term, and that left us with this geometric series, 1 plus delta squared, so on and so forth. And again, the term in parentheses here is somewhat familiar. We didn't do this for an infinite series, but we did do this for a series that ended in period t-1, which is why I've written it this way in the slide. So we can think about taking the limit here of this particular expression. Okay, we can think about taking the limit of the expression that ends with the delta at the t-1 as if t is going towards infinity. So again, that term of parentheses, that's what we want to think about simplifying here. So we're really going to assess the following. We're going to take a look at the limit as if it ends at t-1, but we'll send t to infinity. And we know the limit of the expression on the left, we were able to rewrite that in the first video on asset pricing in terms of this 1 minus delta to the t over 1 minus delta value. And then when we take the limit, recalling that our growth adjusted discount factor delta is between 0 and 1, we wind up in the limit getting a value of 1 over 1 minus delta. And if we substitute this back into our pricing function, then we get a fairly compact expression that the price of the stock is equal to the virtual value D0 times delta over the quantity 1 minus delta. And it's also going to be useful for us here to go ahead and bring back the interest rate and the growth rate into the picture. So we've done a lot of work. We got to this compact pricing formula. But D0 is not part of the original cash flow stream. So let's go ahead and use our definition of the growth adjusted form of delta, carefully substitute that in. And if you do that, you might want to pause the video for a moment and try it yourself. Get a common denominator in the bottom, cancel terms. You should wind up with the following. You should get D0 times 1 plus G all over the difference between R and G, which we've assumed has got to be positive because G is smaller than R. So this is going to be well defined here. And D0 times 1 plus G by definition is equal to D1. So there's really two forms of the pricing function that we can use here. Okay, sometimes it might be useful to think about D0 as the last period dividend that was paid out before you own the stock. Or you could think about D1, maybe the company announced already, hey, we're going to pay out this dividend in the future. We expect to pay out this dividend in the future. And then you might get some estimated value of D1. Okay, so once you have an idea of what D0 or D1 is, then all you need otherwise is a growth projection. Okay, typically, you might be able to look back at the company's prospectus, at their financials for the past few years, maybe take a look at how the growth in net income has changed or how the growth in the dividends have changed in periods past, and make an assumption that that growth rate is going to translate into the future. Okay, so the growth dividend discount model that we've been applying here to really value a share of equity, it allowed us to exploit that uniform annuity framework, provided we had made a little bit of an assumption regarding the structure of how the dividends were related. Okay. Again, if G is equal to 0, then that pricing function converges exactly to the uniform perpetuity solution, right? We just take the uniform dividend, we divide it by R, and we project it, and that's the price of the perpetuity. Okay, now there was one assumption we made here, and that was that R is bigger than G, or the growth rate is smaller than the opportunity cost. And this was important in that this made delta between 0 and 1. If that inequality was flipped, then the discounted value of the payments adjusted for growth actually get bigger in the future, meaning the pricing formula does not converge to a finite number. It actually explodes to infinity. And in general, it should make sense why the growth rate of some investment, or some alternate investment, cannot exceed the opportunity cost of our best investment alternative, which is really what R captures. R is the opportunity cost of our best foregone investment opportunity, right? If my opportunity cost is defined by the rate of 3%, but then I find some other investment that grows at a rate of 5%, then what I thought was my best investment isn't. And really, my opportunity cost should be at a rate of 5%, not 3%. And again, the interest rate capturing the opportunity cost of time, this is your time value of investing. If you find a better outside opportunity, you need to revise your opportunity cost of time upwards to reflect the presence of that improved alternative. Now let's go ahead and apply our pricing function to a numerical example. So suppose we want to value a share of equity that has just paid a dividend of $1 to shareholders. So this dividend was paid before we buy the stock. Okay, so it's not in our dividend stream that we're going to collect from owning the stock. Analysts project that future profit growth is going to be about 3%, and we'll assume that translates into dividend growth. And if the prevailing interest rate in the market is about 5% on our best alternative investment, the question is, what is our willingness to pay for a share of equity predicted by our dividend discount environment? Okay, so I'm going to argue here that we're given the following parameters. That past dividend of $1, that's like our virtual value. That's like D0. Okay, well, D1 is what we're going to get. What was D0? That was the last dividend before D1. So we can actually think about that here concretely in the context of this narrative. If we substitute these values into our pricing function here, then it should be fairly straightforward to compute that the fair market price of the stock in this case, predicted by our dividend discount framework here, is $51.50. Alternatively, we could have structured the narrative a little differently. Rather than telling you they paid a past dividend of $1, we could have said, hey, we expect that next period's dividend is going to be $1.03. Okay, given the same projections of the analyst, the same opportunity cost of capital, and asking the same question, we're really dealing with the same parameter values here, except instead of D0 being given, we're given some expectation of what D1 is, and we can plug those into the formula and we will wind up getting exactly the same result. So this is us using the pricing formula forwards. But you can imagine maybe somebody gives us the price and asks us to figure out things like what is the dividend for a given growth and interest rate, or what is the growth rate for a given past dividend and interest rate. And in that regard, this pricing formula, it can be useful in off-the-cuff calculations. For example, if you were negotiating a merger or acquisition of somebody else's company, and you had to think about what was a fair price of the equity of that company you're going to acquire, what should you offer them in the negotiation? So we could think about kind of utilizing the pricing framework in reverse here, whereby we're considering purchasing some company, let's call it company X in a merger, and we need to figure out a fair price for the outstanding shareholders' equity. And company X, their analyst, who wants to get a high valuation, right? They want to get paid a lot, claims that a valuation of $55 is fair, but we want to be able to negotiate. If we know the prevailing discount rate is 5%, our opportunity cost is 5%, and this company X, just paid a dividend of $1 last period, we can ask ourselves, well, what is the growth rate implied by your valuation? And we can work backwards now, right? We were given D0. We're given the price of the stock, but this is not necessarily the actual price. This is what the analyst claims is the price. So we're going to use the pricing function here to back out the implied growth rate, right? What growth rate is implied by that valuation? So if you watch Shark Tank, you'll kind of see the sharks will do this math pretty quickly off the cuff. And they'll use the dividend discount framework in their heads to do this. So the price of the stock here, right? We're going to use this pricing framework. All we're going to do is we're going to use that equation. We're going to solve for G. So I'm going to multiply through by R minus G. I'm going to distribute. I'm going to isolate G, factor it out, divide through by everything else, get G alone. And we wind up with this expression. We go ahead, we plug in our values, and we find that the implied growth rate here is 3.125%. And that should make some sense, right? In the last numerical example we did, when the growth rate was 3%, that corresponded to a slightly lower stock price of, I think, $51.50. So when the growth rate goes up a little bit, that's associated with a higher projected price. Okay? That is, the analyst valuation in this negotiation implies a growth rate of 3 1/8%. This can be a useful starting point in a negotiation if, in fact, for example, we believed that the growth projections might be actually lower, right? This is the starting point. They offered us 55 per share, but your evaluation implies a growth of 3.125%. We looked at historical figures and we know, or rather we believe, that the growth rate is going to be much lower than that, and hence the valuation should be lower than that in the merger. So this is how, again, you could think about applying the dividend discount pricing framework here to an off-the-cuff valuation. Conclusion and a warning. Okay, we made a big assumption in placing some constant geometric growth structure around the dividend stream in a way that allowed us to exploit a deterministic uniform cash flow framework. And again, the dividend discount model, this is useful in terms of conceptualizing effects of factors that influence stock price, but I would warn you against going home and using this to day trade immediately. Okay. In that some of the assumptions we made may not hold in reality, right? Over time, do the dividends grow at the same constant rate? Answer is no, they change. Even the growth rate changes. What we do see, though, is a few predictions. Increases in the expected future dividends, the expected growth of those dividends will drive the stock price up in terms of the predicted stock price from the model. Similarly, increases in the opportunity cost of capital, increases in that interest rate, cause the present value of the future dividend stream to fall, causing the stock price to fall. So we're still seeing here, even with stocks, in fact, any financial asset, uh, where interest rate is going up, the present value of the benefit stream is going to go down. So there's an inverse relationship, again, between the price of the asset and the rate of return, the interest rate. Again, my warning here, do not use this model in practice to try to find over or undervalued assets in the market. Okay, odds are the information you're using to predict the growth of dividend stream is not as complete as the information that other analysts are. And there are other models of equity valuation that may be more appropriate. Okay, this is the one that was simple enough for us to access, given that we were familiar with this deterministic discounted cash flow framework. But you could use this, for off-the-cuff calculations, roundabout estimates in a negotiation. This is fairly useful. So that is it for equity. One more brief video coming on the relationship between the yield curve and the stock market. Hope that makes sense, and I will see you soon.